All right, today we're diving into ETFs. We're going to break it down like we're having beers, and I'm explaining why buying ETFs is like ordering the sample platter at the pub instead of 20 overpriced appetizers. So, first, what the hell is an ETF? ETF stands for Exchange Traded Fund. Fancy words, but it basically means it's a basket of stocks. Instead of buying Apple, Microsoft, Amazon, Tesla one by one like some Wall Street wannabe, you buy the basket and boom, you own a slice of hundreds or even thousands of companies at once. Diversification without the headache. Imagine it like dating. Instead of committing to one person right away, you get to date the whole damn city at the same time. Less drama, more safety. Now, here's the thing. There isn't just one ETF. Multiple companies make their own versions of ETFs that track the same thing. For example, the S&P 500. That's the 500 biggest US companies. Vanguard makes one, Fidelity makes one, BlackRock makes one. They all basically track the same companies, but they package it slightly different. It's like Coke versus Pepsi versus the cheap grocery store cola. All will rot your teeth the same, but maybe one's cheaper or one has a better label or one doesn't give you gas. And finally, while Vanguard or Fidelity are the ones that actually create the ETFs, you don't have to always buy directly from them. You can buy them like regular stocks through a broker. In Canada, that could be Questrade, Wealthsimple, TD, Direct Investing, or whoever you like. As long as the ETF trades on the market, you can scoop it up. It's like buying shares of Apple or Tesla, except you're buying a basket instead of one company. Speaking of cheap, let's talk about fees. ETFs have something called an MER, or management expense ratio. That's the tiny cut the company takes every year for managing the fund. It's usually super low. We're talking 0.05% to maybe 0.25%. Compare that to mutual funds where you're getting bent over for like 2% every year. 2% might not sound like a lot, but compounding over 30 years, that's like giving away half your wealth for absolutely nothing. So ETFs are the low fee, no nonsense way to invest. Always check the MER. Lower is almost always better. All right, let's get into specific ETFs you might actually buy. VUN, that's Vanguard's Canadian listed ETF that tracks the total US stock market. It's basically holding all the American companies you've heard of and thousands you haven't. When you buy VUN, you're basically buying America. Guns, burgers, tech companies, cars, all of it. Then there's VTI. That's the US version of the same thing, also from Vanguard. Same idea, but here's the catch. VTI trades in US dollars, perfect if you have US dollars or are American. VUN trades in Canadian dollars, which might be easy for Canadians. So which do you pick? Well, VTI has a slightly lower fee and is a bit more tax efficient if you hold it in an RSP, because you avoid the 15% withholding tax on US dividends. But you will need to deal with exchanging money not just once, but twice, which can be a pain in the ass with currency conversions and fees. VUN is easier if you're Canadian and just want to buy in Canadian dollars. It's basically pay a tiny bit more in fees, but the convenience of not worrying about USD. For Europeans and Aussies, there will also be similar products by Vanguard, sometimes in your home currency and sometimes in USD. One thing to know about VUN, or anything that holds US stocks in Canadian dollars, it fluctuates with the US dollar. If the Canadian dollar tanks, your investment looks better. If the Canadian dollar gets stronger, your investment looks weaker. But this works both ways, and over decades it usually evens out. So don't stress too much about whether you're buying in Canadian or US dollar, unless you're planning to retire in Florida and want everything in USD. Other ETFs similar to VUN are XUU from iShares, or just some standard S&P 500 ETFs will do just as good, like VFV, ZSP, or XUS. Now let's hit some other common ones. VCN, this is Vanguard Canadian Index. This one holds Canadian companies, banks, oil, Shopify, Tim Hortons, all the great white north stuff. Here's the problem though, Canada's tiny. Our stock market is like 3% of the global market, and it's basically just banks, oil, and mining. You don't want all your money in Canada because if oil crashes or banks take a hit, you're screwed. But it's good to have some Canadian exposure because you'll be spending Canadian dollars when you retire. XIC and ZCN will also be similar to this. XEF, this is iShares ETF for developed markets outside of North America, sometimes referred to as EAFE or Europe, Asia, and Far East. Think Europe, Japan, Australia. Other ETFs that are similar to XEF are BIU from Vanguard or ZDM from BMO. XEC, that's the emerging markets one. Brazil, India, China. Riskier, but potential for more growth. So if you want a truly global portfolio, you grab some US, which is the VUN or VTI, some Canadian, VCN, some international and developed from XEF, and maybe a sprinkle of emerging markets with XEC. Boom, you own the world. VEE and ZEM are also similar to XEC. Now, bonds. VAB is a Canadian bond ETF. Why own bonds? Well, because stocks are sexy when they're going up, but when shit hits the fan, bonds are the boring uncle who steadies the ship. They don't make you rich, but they protect your wealth. Young people can hold very little bonds, maybe even none, because you've got decades for your stocks to recover. Older folks getting close to retirement might want more bonds because they don't want to lose half their portfolio right before they need the money. XBB from iShares and ZAG from BMO are also similar to VAB. In other countries, you will have other tickers for your local bonds, and Vanguard will probably also have these. Now let's talk REITs, or real estate investment trusts. These are basically stocks that let you invest in a whole portfolio of properties without dealing with clogged toilets or angry tenants. You want a piece of shopping malls, office towers, or apartment blocks. Boom, buy XRE or ZRE and you're in. Real estate can add some diversification. The ROI is different compared to owning a rental house. With a real house, you might make 5 to 7% per year after factoring in costs, stress, and repairs. We should also factor in your time here. With REITs, the ROI tends to be more stable, maybe 3 to 6% in dividends plus some growth. And you don't have to worry about a raccoon moving into the attic or calling over at 4 a.m. to fix a leaked pipe. In Canada, these dividends are also taxed as income, like rental income, so not taxed as efficiently as other ETFs, which give dividends. Other REITs that are similar are VRE or ZRE. Now, let's talk currency hedging. Some ETFs are hedged, meaning they try to cancel out currency fluctuations between USD and Canadian. Sounds good, right? Not really. In practice, hedging often just adds costs and complexity, and it doesn't always work. Over the long term, the ups and downs of currencies usually balance out. So unless you've got a very specific reason, I'd say skip the hedge versions and stick with the plain vanilla ones. And this is important. A lot of people have home country bias. They put way too much in their own country stocks because it feels safe. Canadians buy Canada, Brits buy the FTSE, Americans buy the S&P 500. The reality, the US market is king. It makes up about 60% of the world's stock market, and many of its companies are international. Whether you live in Canada, Europe, or on Mars, you want a big chunk of your portfolio in the US. So what's a good breakdown? If you're Canadian, maybe something like 60% US, 20% Canada, 20% international. If you're younger, load up heavier on stocks. If you're older, tilt more towards bonds. But really the mix depends on your risk tolerance, your age, and your goals. And I can't tell you this. This is something you need to work out for yourself or ask ChatGPT to advise you. Now, where do you put all these ETFs? Tax efficiency matters. For Canadians, RRSP is great for US ETFs like BTI because of the tax treaty. TFSA is best for Canadian and international ETFs where you want tax-free growth, but also American stocks, because in my mind, I'd rather pay no tax on huge capital gains rather than be saving the measly 15% tax on a 1% dividend. REITs and bonds, shove those into the RRSP too, because the income they produce gets taxed heavily outside registered accounts. The big picture is this. ETFs are the best tool for regular people to invest. Low cost, diversified, simple. Don't waste time trying to pick individual stocks unless you want investing to be your full-time job. Just grab broad ETFs, set an allocation, and stick to it. If you ever want the real numbers on an ETF, things like the exact MER, the distribution yield, or how it's performed over time, the easiest way is to look up the fund's fact sheet. Every provider, whether it's Vanguard, iShares, or BMO, has one right on their website. Just Google something like a VUN fact sheet or XEF ETF fact sheet. On that one pager, you'll see the MER listed, the dividend yield, what sectors or countries it's invested in, and a chart of historical growth. It's basically the ETF's resume. This is the best way to compare similar ETFs because sometimes two funds look the same on paper, but one might have slightly lower fees, or a higher yield, or a slightly different mix of companies inside. One last thing, the companies, Vanguard, BlackRock or iShares, BMO, Fidelity, they all offer solid ETFs. Vanguard tends to be the cheapest. BlackRock has a massive selection. Fidelity has some niche ones. At the end of the day, they're all fine. Just focus on what the ETF holds and what the fee is. That's it. Don't overcomplicate it. So there you go. ETFs in a nutshell. Simple, low cost, powerful. They won't make you look smart at a party, but they will make you rich over time. And remember, this isn't financial advice. I'm not your advisor. I'm just the guy explaining what's out there so you can do your own research and don't blow your money on garbage investments. Okay, below I have a table that will show you a breakdown of all these ETFs that we just talked about and what markets they cover. I've also listed similar ones from other providers. Keep in mind that these are the Canadian tickers for these ETFs, but if you live in the US, Europe, Australia, or wherever, there will be similar tickers in your own currency that will cover the same markets. Feel free to write or ask questions in the comments below so we can figure these out for you, or that other people can reply back with ETFs that work for them in your country. Make sure to follow this page, as next week I'm going to dive deeper on which accounts to put each of these ETFs, as tax efficiency needs to start at the beginning before you screw yourself out of hundreds of thousands of dollars in the long run.